The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
Finance Minister says the British arm of the failed American bank SVB.
Hello and welcome to Coin Chronicles. Today we're going to talk about the recent events at Silicon Valley Bank and how regulators have stepped in to prevent a potential financial crisis. Silicon Valley Bank, a key financing hub for tech companies, recently reported that it was struggling financially, triggering a run on the bank's deposits.
All our money is in the bank. I don't know how we're going to do our payroll.
The collapse of such a critical institution could have had devastating effects on the entire financial system. But banking regulators were quick to step in and put measures in place to prevent a panic. Over the weekend, the Treasury Department designated both Silicon Valley Bank and Signature Bank in New York as systemic risks, giving it the authority to unwind both institutions in a way that fully protects all depositors.
Signature Bank, which has an office behind me, is now in the hands of the FDIC. And no matter how you read these tea leaves, these are very troubling financial developments.
Depositors at both failed banks will have full access to their deposits starting Monday. The FDIC's Deposit Insurance Fund will be used to cover depositors, many of whom were uninsured due to the $250,000 cap on guaranteed deposits. This means that those with money at the bank can rest easy knowing that their funds are protected.
When banks experience financial losses, it is and should be a matter of concern.
In addition to protecting depositors, the Federal Reserve has created a new Bank Term Funding Program, BTFP, aimed at safeguarding institutions affected by the market instability of the Silicon Valley Bank failure. The Fed facility will offer loans of up to 1 year to banks, saving associations, credit unions, and other institutions. The Treasury Department is also providing up to $25 billion from its Exchange Stabilization Fund as a backstop for any potential losses from the funding program. Despite the measures put in place, some are still concerned about the potential for contagion and fear that this could trigger another financial crisis similar to what we saw in 2008.
During the financial crisis, there were investors and owners of systemic large banks that were bailed out. We're not going to do that again.
However, regulators have emphasized that there will be no bailouts and no taxpayer costs associated with any of the new plans. Shareholders and some unsecured creditors will not be protected and will lose all of their investments. In conclusion, the recent events at Silicon Valley Bank have once again highlighted the importance of a stable financial system. While the measures put in place have been effective in preventing a crisis, we must remain vigilant and continue to regulate the financial system to ensure its stability. If you found this video informative, please like and subscribe for more updates on the latest financial news.